How's it going, everyone? It's Sam. I want to talk to you today about a stock that is very similar to Affirm and could possibly be the next Affirm. It's actually trading a lot cheaper and it already has ties to Affirm and already helps them, and they work together actually. So I'll walk you through it, why this company is so fascinating. It's basically a penny stock, but you can't really think about it as a penny stock because then it makes it sound gimmicky or something like that. It has been beaten down recently and there is some upside potential here. If you guys don't mind hitting the like button, I do appreciate that. It helps out the channel, tells me you like videos just like this and you want me to do more videos like this, kind of breaking down an interesting stock. Also, if you guys want to see exactly what I'm buying and selling, because I have been buying and selling a little bit recently, you can check out the link down below to the Patreon. There you can join over a couple thousand other people in the Patreon, in the Discord, so definitely check that out. Also, if you guys want, there is a link underneath the video to Webull, where you can actually get some free money just for signing up. Who knows how much you can make right now, but it's several $100s and you get to try out their platform, which I really like. So let's look at this stock here today. The stock is Catapult. And right now, this is about a $625 million company with revenues that are in the 300 million range. Now, this is a fintech company. It runs things pretty lean. It was EBITDA positive in Q1, and it's kind of similar to Affirm. So if you know Affirm, this has gotten a lot of attention recently because they've recently started to work with Amazon. So basically what Affirm does is you purchase something, and when you're purchasing, maybe you don't have enough money to pay for it up front, or maybe you just don't want to, so you can make installment payments. I'm sure you've seen this before on different websites. Instead of a $400 thing that you're buying, it's 4 payments of $100 or something like that. Just makes it a little bit easier. Maybe you know you're going to get paid a lot more in the next couple of weeks from something, especially if you're a contractor or something like that. So it just helps take off some of the pressure. Now, Affirm makes a lot of money from taking those payments and actually getting a percentage of it from the people that they service or the companies that they service. So they get a percentage of the sale. Now, Affirm itself does make money from interest. So they actually charge between 15 and 20% interest if you don't qualify for the 0%, but it's still not the majority of their income. You can see interest income the last quarter was about 104 million compared to their total revenue of 262 million. And again, they're charging 15 to 20%, which is a little bit lower than a credit card. What's interesting about this company, Catapult, is they already are working with Affirm right now. So they have good customer reviews, a 4.4 rating out of about 15,000 reviews. What they're doing is they're working on Affirm Connect. They've integrated Catapult, a lease-to-own payment option, so that customers who aren't approved for Affirm can get a secondary way to pay. So basically, if your credit is too low, then you can consider Catapult. If qualified, they're approved and notified all real time within the same flow. So you don't have to go try to apply to Affirm and then try to apply to Catapult too. It's a little bit more seamless that way. Now, this helps some people that maybe they just don't have credit, maybe they need something today. They know that they're going to get paid a lot more in the coming weeks, kind of like Affirm, but basically if they don't have credit. Now, what's interesting, this is actually, and I want to be careful here because I want you guys to do your own research. Everyone has different views. This reminds me, after looking at the payment structure, a lot about similar to a payday lender. So they charge $15 to $20 for every $100 borrowed. The APR is usually 391% to 521%. So like 400 to 500%. Now, let me be clear. This company is not that bad. It's not in the 400% range, but it is not cheap. So after digging into this company a little bit, this is how it works. You pay off your lease within the first 90 days for just 5% over the cash price plus your initial payment and applicable taxes. So you might be reading this and wondering, okay, what does this actually mean? 5% over cash price and your initial payment. So this is how it breaks down. If you pay something within 90 days, let's say you're paying something that costs $300, you can pay 90 days, you can pay $360. So that means your initial payment is $45. So you have to pay an initial payment up front. Also, you have to pay 5%. So 5% of $300 is $15. So the initial payment is $45. You also have to pay that $15 upfront, that 5%. And basically, they say that there's no interest They say that there's no APR on these different loans or rent-to-owns, but that's because they pay a significant amount depending on how long you actually hold it for. So 90 days, it costs you $360. Mid-lease cost of ownership is $450, and then total full-term cost of ownership, and I believe this is a year and a half, is $645. So that is about a 122% return for them. If you look at something that's a $700, you can break it down. It's very similar. At $45 up front, $35 for the initial 5% fee. That's $80. And then you can see that the cost goes up to about double after the full term cost of ownership. So it is a little bit cheaper because you have that flat fee of $45 up front, but you still have the 5% fee. So as you get higher and higher, it becomes a little bit more affordable. But you have to realize that this is still an insane amount of money. I mean, you're talking about basically double the payments. What's interesting too is they say that this is $50 per month, and that's really only the case if you take this full long-term option. That's still a significant amount of money because this is $645 compared to the $300 lease here. So it's double the amount, but they break it down saying, oh, it's only $50 per month. But this is going to be over a significant amount of time. I mean, this looks like it's over 12 months, right? If you have to pay $50 a month times 12 months, that's $600, and then the $45 payment up front. I'm not sure where all the other money comes from, right? Because they say 5%, and then they also say an initial payment of $45. So how are they making the extra $285? I'm not exactly sure, and it's not real clear because they say that there are no late fees. They also say the sooner you pay it off, the more you save, but they also say that there's no interest rate. So they must do some more costs or some more upfront costs, something like that they shield as not interest in this $645, but they have not made that clear. It's really easy to do the math on the 3 months because it's really simple, 5% plus the initial payment. But after that, it's not real clear how they get to the higher payment amounts. And again, this dollar amount up here is based on this full term cost of ownership. So I will say this company does have some upside. We know that Affirm is working with Amazon and Affirm's also working with Catapult. So it's not out of the question that they could work with Amazon in the future. Catapult did fall recently because this was a SPAC. This was a SPAC that cost about $20. And up until recently, even in the beginning of August, it was about a $10 stock, and then it fell all the way to about $3. Now, why was this? It's because they actually reported a loss on EBITDA. Also, they pulled guidance for the second quarter. They had significant growth in the first quarter. They had about $80 million worth of revenue, an increase of 88% year over year. They had about $64 million worth of gross originations. They onboarded 26 new retailers. EBITDA was $14.7 million. And then second quarter, their revenue went down. Their gross originations were about the same. They onboarded more retailers than the quarter before, but they had a net loss of $8.1 million. They observed meaningful changes in both e-commerce, retail sales forecasts, and consumer spending behavior in the past few weeks. And then they pulled guidance. So that definitely caused the price to go down. Now, some people are excited about this, not just because of the potential for big earnings, but because of how much of it is shorted. Short percentage of float is 23%. Compare that to something like GME, it's only 12%. Days to cover is about 1.5 days. So a lot of people are looking at it on Wall Street Bets just for the short squeeze potential. Compared to Affirm here, Affirm is about $29 billion, and their revenue is somewhere in the $1 billion range for the year, most likely, based on current run rates. So you take a look at this. This is about a 29 price to sales ratio compared to this company, Catapult, which is basically a 2 price to sales ratio. So it is a lot cheaper. Am I buying the stock? Not at this point. I find this a really interesting stock. Someone in the Patreon reached out to me about this. And while they're growing revenues very quickly, I could see this being something where Amazon draws the line in the sand and says, hey, we will allow you to use Affirm because it doesn't actually charge you anymore, but Catapult is charging 20% over 3 months. And I could see them saying, we're not going to allow that for our customers. That is a bad look. and then it could drop off. Now, I'm not saying that will necessarily happen, but also I could see potential for litigation in the future. I mean, this is basically in between a credit card interest rate and a payday loan interest rate, right? We're talking about 200%, 100 to 200% interest rates. Right now, I feel like this is a little bit of a risk. I mean, obviously they've gone public. Obviously, the SEC knows what they do, but I could see this being a potential problem in the future. And part of it is just my own morals, right? I don't want to make money off the backs of other people paying 100% interest rates. I think that's much too high. Even credit cards at 20 to 25% are extremely high in the normal finance world, but we're talking about a 20% loan over 3 months for something that people probably shouldn't finance. Now, of course, you can feel totally different than I do, and of course, anything can happen. I don't have a crystal ball. I think this company, if they're allowed to do what they want to do, will make insane amounts of money. I mean, they're charging a lot of interest. Of course, they're going to make a lot of money. But always do your own research. Thank you guys for watching. I did want to bring this to you because it is an interesting company that is kind of similar to a firm, but probably is going to be a lot more profitable, at least for their size, because of the fact that they charge such a high interest rate. And it is good to look at different companies that are associated with companies that you might be looking at. So thank you guys so much for watching. I really appreciate it. Thank you for hitting the like button and checking out the link down below to Webull, and I will see you in the next video. Let me know what you think about this company down below.